Hello and good morning. I welcome you to the morning meeting today on Tuesday, the 6th of March 2018. This is Jens Klatt speaking and exclusively presenting this format to you here for JFD Brokers as the global head of research and education. And we want to have a look at the developments in the markets. So the DAX, in fact, started out on a roller coaster into the trading week. Yesterday, you may remember that the first hour of trading here, the DAX sold off sharply below 11,900 points, traded close and short of 11,700 points, and then bounced back aggressively. And not just that, but it really took off into the evening here, thanks to also some strong momentum in the US equity markets on the upside. And in fact, closed the day significantly above 12,000 points, and currently is trading above 12,200 points here, and aiming, probably a quite significant a resistance zone here on the upside range, 12,270 to 12,300. 12,330 points here. So in fact, in the morning we traded as high as 12,700 and 12,274, and didn't make it above that level. Nevertheless, I think there's still some room on the upside, and I think at least some potential to see another test of this region here. Not sure whether the market can significantly break above this level. That's the thing. And on top of that, everything below 12,600 to 650 points in the DAX should be considered short. So if you're long, then you're definitely anti-cyclical positioned here. Nevertheless, let's see whether we can see another attack at this level or not. But the thing is that right now it seems as if the equity markets can shake off all fears around trade wars, which were brought up to some extent, respectively, at least between the lines, from Donald Trump last week on Thursday, which resulted here in a quite significant drop then on the downside. We have seen fears probably also around the election in Italy. Over the weekend here, we have seen fears that there is no, in terms of the Grand Coalition here from the Social Democrats here, and all this, it's going away. It's not playing a big role anymore, and so the thing is that what we definitely need for another leg lower and a quite significant attack, and then also significant break and sustainable break below 11,900 points, we need an external trigger, and there are no external triggers out there anymore, which makes it unlikely that the DAX will see a sharp drop rather sooner than later. Not that it's unlikely. We have to remember that, for example, here in the Dow Jones, and the DAX is currently closely linked to the development here in the US equity markets, that we have a good chance that rather sooner or later there will be another leg lower. I still believe that there's a high chance that over the upcoming months, especially, the Dow Jones won't see such a one-way street as it did here since the election of Donald Trump, and then which ended then dramatically, we have to say that, here at the beginning of February, but that we stabilize and see bigger swings on an elevated level here. So there's still the chance that there will be another push lower somewhere in the future. But right now, I have to say that I highly doubt that there's so much potential on the downside here for the DAX, and that's why I currently favor long engagements over short ones. And on top of that, also that I doubt that we will find strong resistance here in this region. That doesn't necessarily mean that we just overrun this zone of significant resistance here between 280, 300, 330. Nevertheless, I don't see the market really seeing a strong bounce against this level here. And so that said, let's have a look at the intraday picture. So everything above this blue line here is the 50 exponential moving average. I think is should be considered long. We have a good chance to at least see another attack, the region around 265 to 75 here. If we break above that, again, quite strong resistance then at 280, 300, respectively 330 if we overshoot a little. And from a risk-reward perspective, real difficult to trade, in fact, because if you plan to trade the direct breakout of the open range, currently we're trading within the open range, as you can see here with those two purple lines. If you trade it directly and go long with a break above 274 and place your stop here at 186, then we're talking about 88 points risk, while the chances on the upside are maximum 60 points, I'd say. So if we really go for 12,330, and from a risk reward perspective, this is giving us a risk reward ratio of less than 1, which is not attractive enough to trade such a setup. And so we have to find other ways to trade it, or probably consider not trading such a break on the upside at all, even though I mean, there are probably some people out there thinking, okay, if you're not long, well, then you're short. In the current state, as already explained here at the beginning, I don't like to be short at all. And so let's just see what the US equity markets deliver. What I can already say, or what you've probably already seen, is that the S&P saw a tremendous rise yesterday, the really strong momentum on the upside, which pushed us over 2% into the green here once we broke out of this open range, which was something around 2,684, and took off from there. And as you can see, we traded as high as 2,728 points. This is nearly 50 points within one trading day. Quite significant push, and it doesn't look as if the market really wants to pull back, but instead stabilize at a quite elevated level. And with this in mind, I think we have a good chance to probably continue with this momentum. Then again on Thursday with the ECB especially, I mean the tide could turn. Nevertheless, currently the momentum should be seen on the upside, and there's no real reason to believe that there will be a very, very restrictive rhetoric from Mario Draghi on the press conference. And this is mainly due to the fact that last week's inflation numbers here for the Eurozone came in as expected, but significantly below the target rate at 2% here, at 1.2%. And this makes it more likely that the ECB probably will start an attempt to also down-talk the euro, which would be positive for European equities, and also to some extent, and based on the fact that the Fed is reducing their monetary easing, especially already reduced it to 0, and in fact starts to reverse their easing policy here. That this could also mean some support from the ECB then for US equities. But let's especially look at the euro here, even though we want to make this a topic in the upcoming days in the morning meetings. Nevertheless, currently I think chances of higher volatility are reduced. That's mainly due to the fact that we have only ADP data coming out tomorrow before the ECB, and then we have the ECB on Thursday and the NFPs on Friday. This is ADP and NFPs are related to the US dollar. So with the ECB especially around the corner, I think chances to see higher volatility in EURUSD are not that high. And that's one of the reasons why there should be usually a quite volatile and probably technical trading before the ECB on Thursday then. Technically relevant level on the upside, still 123.50. If we break above that, there's further room up to 124, probably slightly above that. If the ECB comes out more dovish to start an attempt to down-talk the euro, probably to take some revenge on the Trump administration especially. Sounds a little ridiculous, but remember what happened on the 24th of January in Davos. Steven Mnuchin here aggressively down-talked the US dollar, and if you carefully listened to the last press conference with Mario Draghi, usually central bank president here should be neutral, objective, relaxed. That's usually what you expect, and that's usually what we've seen from Draghi over and over again. But On the 25th of January, one day after München started its attempt to down talk the dollar, he really got furious on the press conference and was quite direct, quite aggressive in his rhetoric here. And so to me, it's not such, I mean, it's definitely a possibility that here there will be an attempt to somehow down talk the euro now, especially bringing up the dampened inflation outlook. And this could then not just lift equities higher, but also push the euro USD in this case significantly lower. But till then, I think chances of bigger volatility are definitely reduced here. And 23.50 on the upside is the key level to watch. If we break above that, there's short-term. It's a short-term bullish level which could lift us up to 124, probably slightly higher than that. If we don't make it above that level, probably we see a pullback. Again towards 122.70, 123, but all in all, volatility shouldn't be that high. And in fact, I have to say that that's it, because there's no more news here. We can probably have a look at the Australian dollar, and the fact that the RBA left the cash rate here at the same level as before, interest rates at 1.5%. And what they emphasized here was that the wage growth remains elusive here, and the respectively that wage growth and inflation here remain low and do not justify any more or any restrictive monetary policy approach here with lifting or raising high rates here. And with this in mind, I somehow have a more bearish feeling since then, by the way. So as you can see, you might say, oh well, initially, even though volatility is quite low here too, but it seems as if the Aussie dollar reacted bullish. No, it didn't. In fact, the market traded already at its daily highs and started to not aggressively sell off, but nevertheless drift lower here from the comments from the RBA. Currently can recover some of these losses, but mainly due to the fact that US dollar is not so strong today. And so with this in mind, I have to say that I have somehow a quite negative outlook for the Australian dollar, even though I'm also skeptical about the US dollar, meaning that probably currency pairs like Australian dollar, Japanese yen, especially with the markets now building speculation around a more restrictive monetary policy approach from the Bank of Japan from next year, March, April 2019 then onwards. It could mean that Australian dollar, Japanese yen probably has some potential. And this is especially true since currently, as I will show you right now, we are trading at the 2017 yearly low. So if you zoom out of the chart, you can see here that's a quite significant region. And if we break below that, especially once risk aversion probably kicks in here, we are definitely capable of making it down significantly below 80 and probably down as low as 76 here. Region around the not necessarily as low as here 2016 year lows 72, but definitely here as low as 76 if we break below the 2017 year low. So Australian dollar, Japanese yen, it's kind of it's definitely worth watching. Let's say it's worth watching, and currently it seems as if the Australian dollar is not yet done on the downside, but has some further potential, especially. Yeah, if risk aversion kicks in, volatility stays higher than as in the months before, and so Australian dollar, Japanese yen could definitely be worth watching. And that's it from my end. So I hope that you enjoyed the morning meeting. And if you want any further infos on the markets, just shoot me an email, contact me via Twitter. I'd really appreciate to contact you, respectively to answer your questions. And that's it from my end. So happy trading. Watch your stops. Talk to you again tomorrow, 10:30 a.m. GMT. I definitely look forward to it, and wish you all the best. Happy trading. Take care. See you, and bye-bye.